So hello again and welcome to another ISBA webinar, and today we're going to be looking at demystifying leasing for independent schools. So welcome back. My name is Helen Woods and I'm the Director of Learning and Development at ISBA. And before I hand over to our panel of speakers today, I'd like to just help you get a bit out of the session by going through some housekeeping points. So the webinar is being recorded, and the recording and the slides will be available in the ISBA reference library, and you'll be notified by email when these are available to view. Please do feel free to ask questions of our speakers, and you can do that by typing your questions in the chat box, which you should be able to see in the chat bubble at the bottom of the screen. And we'll take some time at the end of the session to answer your questions. You can turn on closed captioning, and again, that icon is at the bottom of the screen to do that. And at the end of the webinar, a short feedback survey will pop up in your browser. So please do feel free to it'll only take a few seconds to give us some feedback on the session. So if we can move on to the next slide, here are our speakers today. So I'm very pleased to welcome 4 speakers. We are joined by Sophie Hayes, who is the Business Development Director at Devices for Education by HardSoft. So Sophie is responsible for developing the best possible leasing solutions for schools and ensuring that the one-to-one schemes, whether they're school or parent-led, are successful. And Sophie is going to tell you more about the financial landscape for independent schools and why leasing could be an option to consider. And she'll also look at the overall benefits of leasing in schools. Next, we're joined by Andrew Morgan, who co-founded HardSoft Computers in 1983. You don't look old enough, Andy, so he will be introducing you to leasing as a concept, as well as the ideal process for your school. And then you'll also hear from him about contracts and compliance, and offering a survival guide so you know how to recognise suspicious lease providers. Our next speaker, I'm pleased to welcome, is Dr. John Carlin, who is the Deputy Head and Head of Digital Learning and the DSL at St Edmunds School in Hindhead. And as a client of HardSoft, John will be sharing his leasing experience of working with their successful one-to-one device scheme. And finally, it's my pleasure to welcome Louise Hallsworth, Director at Affinity Accountants. Now, Louise specialises in the education sector, and she helps independent schools and academies with their accounts and audits. And with her experience as a chartered accountant, Louise will be helping us demystify the tax implications of leasing for schools. So a lot to cover. So I'm now going to hand over to Sophie to take it away. So thank you very much, Sophie.
Thanks so much, Helen, and a big thank you to all of you today for joining us this morning while we demystify leasing for independent schools. As Helen mentioned, my name is Sophie Hayes and I'm Business Development Director at Devices for Education by HardSoft. We've been a pillar in the technology leasing industry for over 40 years. And leasing and device as a service is all that we do. You could argue it's very much my life. And as an ISBA Platinum partner, we want to thank the Independent Schools Bursars Association for giving us the opportunity to share our experience and expertise with you today. Next slide, please. So let's start by addressing the elephant in the room. Historically, leasing has faced challenges related to its reputation. For many, the term leasing may evoke thoughts of inflated prices and hidden fees. This perception was further reinforced by BBC's Panorama investigations, which revealed that schools across the UK were being charged up to 10 times the appropriate amount for leasing equipment. Next slide, please. The Department for Education reacted quickly to the surfacing leasing scandals and introduced new rules and regulations. This fortunately means that majority of leasing solutions found today are fair and flexible. However, these past issues should still serve as a stark reminder that it is important to do your due diligence when choosing the right partner. One of their key suggestions is to only work alongside a leasing provider that's a member of the Finance and Leasing Association, or otherwise known as the FLA. The FLA holds their members accountable to a strict code of conduct, meaning any business with their stamp of approval is committed to offering fair, transparent agreements that do put the school needs first. Devices for Education is one of those members. Next slide, please. So let's move on. Why should independent schools consider leasing now? Why is this relevant to you today? When fully understood and properly executed, leasing emerges as a smart and flexible and cost-effective alternative to outright purchasing. While many state schools have been making the most of leasing for a long time, the concept may be more of an emerging solution for independent schools, which is perhaps now more attractive due to the extra pressures and financial challenges you may be facing. The combined impact of inflation, rising technology demands in classrooms, and financial obstacles from the new government have placed independent schools in a difficult position. Now, you will all understand the financial implications for 2025 better than I do, but here's a quick summary. The sudden application of 20% VAT on school fees has sent shockwaves through your budgets. Parents are feeling the pinch, and bursars are caught in the impossible position of balancing financial stability with affordability. The loss of business rate relief has also caused an unavoidable expense, and what's more, you've got the increased expense of employers' national insurance. Now, each of these changes introduces uncertainty and increases the pressure to ensure your school remains competitive and attractive to parents and students, despite perhaps having a reduced budget. The predictable monthly payments associated with leasing without the need for large upfront investments can be a method for you to address potential future cash flow issues. This approach also enables your school to maintain and advance the high standards of education that the market expects. I'm now going to pass over to my colleague and Devices for Education's co-founder, Andrew, who will dive into different types of leasing and what an ideal leasing experience might look like. If we can just go to the slide earlier for one moment, I just wanted to share my personal contact details, because do feel free to contact me directly about anything I have just shared, or if you have any questions around device leasing schemes. Next slide, please, and over to Andrew.
There we go. Thanks, Sophie. So let's crack on and let's go a little bit deeper with a proper introduction to leasing. So leasing is a very simple arrangement. So it's a simple arrangement where the school or business can use an asset without having to purchase it outright. So instead, the school pays for the use of the asset over several years. So that could be 1 year and in some cases up to 7 years. And you typically make the payments monthly, or often for schools, it's done on a termly basis. The lease can often include a service element, meaning support, maintenance, and even installation costs can be part of the lease agreement. Next slide, please. So what can schools lease? Well, I'm going to say almost anything now. You've got a whole range of assets, and popular, very much amongst state schools and academies, is the gym equipment, playground equipment, minibuses, and computers, to name just a few things. Essentially, if it's something your school needs but doesn't need to buy it up front, it's likely you'll be able to lease it. Next slide, please. So types of leasing. So once you've decided on what you're looking to lease, there's a couple of different types of leasing contracts you need to be aware of. So firstly, you've got a finance lease. Finance lease is, I would say, is more akin to a HP agreement. You take on more responsibility for the equipment. So generally your handling maintenance and support is down to you. And generally it includes ownership of the equipment at the end of the agreement. Louise later will have some comments on what you can and what you can't own. So it's useful for assets you plan to keep for long term. So we would always say classroom furniture, which could last anything from 5 to 15 years, playground equipment, that is your go-to for finance leases. Generally though, finance leases are rare these days, as they offer little benefit past cash flow. And they don't have the ability to have the services support which are vital. Next slide, please. So we've got an operating lease. So operating lease, OPEX lease, different terminology. New terminology very much the last few years is the word of calling them a rental leases. So you technically are renting the equipment, and like any rental, you rent it and then you return it at the end. When you return it at the end, you're then in a scenario where you've got then to either upgrade the equipment, keep the equipment, or enter a new agreement. So an operating lease can have options to cancel, upgrade, or change early within the contract term. So it does offer greater flexibility. It's also cheaper. So it's cheaper because you're only renting it and the lease company gets the equipment back at the end. Question often asked, and there's loads of questions surrounding leasing, but how much cheaper is it if you try and compare the two? So it's an interesting question that I can answer from the aspect of computers because it does have a clear differentiation. So the higher the residual value of the equipment, the cheaper the rental. So in computing terms, a MacBook Air after 3 years is worth about £300. A similar Windows laptop could be worth just £100. So while equipment is similarly priced brand new, the rental cost becomes somewhat cheaper for the Mac in this example, as the lease company will receive a device with more resale value at the end of the agreement. So in short, finance leasing has a longer term focus and may include ownership, so perfect for this gym and playground kit, whilst an operating lease or rental lease has a shorter term focus, more flexibility, perfect for computers. So operating leases are treated as rentals by HMRC, and so VAT is applied on top to each monthly rental payment. So in the past, the operating lease in respect of yourselves and the independent schools would be more expensive as you weren't VAT registered and couldn't claim the VAT back. Now that you're all VAT registered, you can reclaim it. Louise can cover this all in depth a bit later, but this major change has really opened the door for independent schools to start looking at operating leases as a true alternative to your traditional purchasing path. Next slide, please. So let's look at some of the different types. Let's go through the process of arranging an operating lease. So you've decided on the equipment, you found a supplier, you're on the start of a journey and the leasing story begins. You need to find a finance provider. So if you're a business, most people end up looking at a broker. So there's plenty of brokers out there who will arrange finance, but at a cost. Schools, independent schools, you don't need a broker, as in reality, independent schools have high quality credit and you'll have no issues directly approaching a bank or finance company. So that's removing the middleman and going direct. So some of the lease companies you'll come across as you look around will be names such as you can see on the slide there, CHG Meridian, who are, I think they're, I'm just trying to think where they're all from. None of them are in the UK. So German, Siemens, BNP Paribas, who are French. This direct approach of seeking finance has the advantage of being cheaper, but of course you need to be careful because if you're dealing direct, you need to actually have a strong understanding of finance agreements. As being unprepared could lead to agreeing to terms that are maybe unsuitable for your school. And also dealing direct with a bank, we all know the customer service standards of your bank, and just to say they're pretty poor is probably down there, but there we go. So be careful if you're going to go direct. So it's still on the journey to providing and finding that finance company. And if you do, and when you do, there's some key questions to start looking at and asking. Next slide, please. So as Sophie mentioned earlier in the presentation, the first question we'll ask is, are you a member of the Finance and Leasing Association? I can't sort of, you've absolute first question, and I can think of finance companies that are not. So the Department of Education advises working only with FLA members, and you will get a accountable and transparent agreement. So this guide that the Department for Education publishes is available on the internet. It is a weighty document. It was originally written for academies and is probably your go-to reading. It is completely buried in the internet amongst loads of other guides from the D3. So give us a shout. I'm happy to provide the link to the document if you can't find it. So once you've chosen a finance partner and you've got your equipment supplier, you need to be ready to navigate the contract. The contract you need to go into with eyes open. Next slide, please. So you've got that contract in front of you, and we all know it's going to have lots of words and terminologies that you may not be used to. So the first thing to look out for is, let's look at for the hidden fees. So the first thing is the annual service fee. So this is buried again on page 3 in subsection 28, as it were. And they're going to charge you annually to look after your account. I don't think it's justified, and I don't really understand what it's for. But personally, I think you should ask for it to be removed. You've then also got the initial admin fee or administration fee. So you've probably encountered these in your day-to-day life anyway. So any finance contract, from a mortgage even to a car loan these days, they try to put on, so they'll take your first payment plus an admin fee. Again, I'm not quite understanding what the justification is for entering into a relationship and what the actual cost is covering. So I've seen admin fees that actually can start with a 4-figure sum. So you need to negotiate these down. I think a £0 admin fee is you need to get to 0. Again, because I don't think it's fair for them to charge you. You've agreed a price and then suddenly you've got a contract and they seem to be, oh yes, don't forget there's this admin fee. So there's insurance there, and it's not a hidden fee, but I think it could be a hidden cost, and it becomes a major factor. So insurance, you'll need to prove that the new equipment is insured against damage and theft. So that's not a concern for playground equipment. It's probably covered as part of your normal cover. But it becomes essential when you're looking at considering the expenses related to a laptop. So a laptop could very quickly and easily, given the fact that children are dealing with these things, will have a damaged screen, you lose a charger, worst case scenario, the item goes missing. So often your supplier will have provided you some cover in-house, but for any lease, you must have sufficient cover in place. The lease company themselves will impose their own costly cover if you choose to ignore their request for a copy of your insurance policy. So essentially, please put it on the agenda before rather than later. So any lease company that's worthy of your trust for building a long-term relationship with leasing should be happy to consider and change any of these terms that don't suit you. So let's now jump ahead and cover the experience at the end of the contract. Next slide, please. So we're still in an operating lease, a rental lease. So what happens at the end of the lease? Payments are going to cease automatically, and you legally own the equipment if it was a finance lease. So not a lot happens there at all. On an operating lease, a lot's going to happen. So that's going to start with you giving written notice to end the contract, so the payments stop on the day you expect them to stop. So assuming you have wisely given notice, the payments have ceased, you'll need to start the process of returning the equipment. Remember, you're just renting the equipment, and the lease company is going to make its money from the resale of that equipment. So they'll need it back in a reasonable condition. They will allow you fair wear and tear, but anything beyond that, you're responsible for, and you will get a hefty bill for it. Their definition of fair wear and tear might not necessarily be in sync with your own. So make sure they provide you really clear details and you ask the questions of what they expect. I've seen some seriously punitive definitions of fair and tear over the years, so please be careful. Next slide. Lastly, don't forget to inquire about the logistics of returning. Is it up to you to box everything up? Do they send somebody to collect it? Are there any fees for that collection? I know some schools have returned computers in perfect condition under the fair wear and tear policy, but have then been charged a really significant fee to arrange for that collection. And I've even seen additional rental fees if you return the equipment just a few days beyond the contract end date. So again, it's important that you're really aware of all these details before you enter into the agreement in the first place. There won't be any unfortunate surprises lying in wait for a few years down the way. Let's just keep them clear. Next slide, please. So how can we sum this all up for you? So leasing has a really valuable place in your financial toolbox when used wisely. And those new VAT changes have made operating leases into an attractive option for independent schools again. Next slide.
Perfect. Andrew?
So that's what you've done.
Thank you so much, and what a great start. And I think just to summarise there as well, I would recommend you start with that Department for Education document and their guidelines. As Andrew said, he'd be happy to share the link if you contact him directly after the session. And then really go to tender and contact several FLA accredited partners. And from there, get your questions ready and challenge those agreements, highlighting the areas that Andrew has just gone over. Now, I'm going to hand over to Dr. John Carlin, who will take you through St Edmunds School's experience of leasing and how they've been able to use a leasing scheme to progress their digital learning journey. Over to you, John.
Hi, thank you very much. And you'll see on screen not a picture of me, but in fact of Reverend John Morgan Brown, who set up the school just with 7 boys back in 1874. And if you could just go on to the next slide for me. The school was originally located in Norfolk, and children attended 2 church services a day with lessons of English, classics, religious, maths, French and music. But we ended up moving, if you can move on to the next slide for me, to our current site in Hindhead in 1899. And it was a choice of the clean air and scenery because the Reverend's sister had some lung condition, so we moved over. We've been here for over 100 years now, and we've seen many changes, which I'll talk about very briefly before we move on to our leasing strategy, which has included obviously sports facilities and very exciting, all of our digital strategy as well. If you can move on to the next slide for me. Our current headmaster is Dr. Adam Wallaker, who joined St Edmunds with his family back in 2000 and has been responsible for converting St Edmunds from an all-boys school to a co-ed school in 2008. And then there was the addition of our successful senior school going up to Form 11 and GCSEs back in 2014. If you could move on to the next slide, I do want to mention our wonderful bursar, Julie Beeston, who joined the school back in 2014. And the school has grown from 250 students up to almost 650 students at our current Hindhead site. And we have this academic year just had a prep school in Godalming join our trust. So we're a very busy and vibrant school. And if you can move on to the next slide for me, we go from the age of 2, we've got our nursery program in EYFS, and that feeds into our prep and our senior school with our GCSE program starting at Form 9. Now, obviously, we have to manage all of the different additions that we've done to the school. And I know that you've spoken, if you can move on to the next slide for me, about the different leasing strategies and different things that a school might lease. We lease typically, as many schools do, things like our minibuses, but also our computers and our electronic devices are leased. Now, our Form 8s go through a very intensive device training and digital literacy program to prepare them for when they go into their senior school. And we use a kind of hybrid and device strategy for the GCSEs as the exam boards are still testing and trialing the digital exams. Just moving on to the next slide for me. We re-looked at our device program and whether or not we should lease during the COVID pandemic. And we realized the need for an enhanced digital program. And when we started to look at it, we obviously needed to decide what type of educational platform and what type of device Apple, Microsoft, and Google Chromebooks we might choose from. And if you can go on to the next slide for me, we decided at the time, as we had been a Microsoft-based school, that this was going to be the platform that we would choose to pursue. And having A1+ licenses has meant that we have, in Microsoft, meant that we have access both to the desktop and the online apps, which our teachers and students can use in their lessons. And if you can move on to the next slide for me. We started off by looking at developing the strategy. We spoke to 10 different schools of different sizes, and we spoke to both the SMT members that were involved in deciding on their own strategy, staff members, teachers that were using the devices, parents and children. And it supported our decision to go down a Microsoft route, but we needed to think about the type of devices that we were going to use and how we would obtain them. Now, speaking with my bursar just the other day, reflecting on this time period, the COVID pandemic, we decided to go down the leasing option, which was the best at the time for our cash flow in terms of obtaining devices for our teachers. And if you can move on to the next slide for me, we decided to select the Microsoft Surface devices for their flexibility. Now, they were not the cheapest device, and I remember having multiple meetings with my bursar and the headmaster about the investment into this style of device, both for the teachers and the students. But we felt that it gave us the best ability to create dynamic and engaging lesson resources and to teach our students about technology that they would use for the future. The leasing strategy also gave us time, if we can move on to the next slide, to look at all of the kind of accessories that we might need to have as well, both from the charging banks for teachers, the different rental banks that we have for devices around the school. And if you can go on to the next slide, the student lockers, where during form time and tutor time, they need to keep their devices safe and to charge over the break times. Now, some of these accessory kind of options just here are a mixture of either leased or purchased, depending on what we felt was unlikely, the technology to change. It would be, we could use it for several years. If you can move on to the next slide for me. This included things like our BenQ touch screens that we use, which are HDMI and wireless technology as well. And those are all the sorts of things we had to consider when we were deciding both for our device use and our leasing options as well. Now, if you can move on to the next slide for me. About 10 years ago, we had tried a strategy of the school providing devices for students to use in their lessons. So these were devices that the school had bought. After just 6 months, our own IT department was swamped with faulty and damaged devices, as we found students didn't take much care of school-owned devices, or as much care as we would have liked. This affected the school as we became almost uninsurable for device damage. So in our new iteration of our device strategy, we decided that whilst we would lease devices for our staff members, and we did so 12 months before we rolled out officially this new strategy to give our staff time and training to use them, as well as resource creation, we decided that what we would choose that would work for St Edmunds is that it would be student-owned devices, and parents would be able to select from a specific range of devices. We were very specific because it meant that we could not only have an understanding of how they worked, teachers could be trained if there are any common faults or problems, and also we could carry a small range of spares if needed as well. Now, in this new iteration of leasing options for parents, we decided there was going to be 3 devices at the time, which was the Microsoft Surface Go, a slightly smaller and more cost-effective model, Microsoft Surface Pro 7 and a Microsoft Surface Pro 7 Plus, almost a Goldilocks strategy. And parents had the option of purchasing outright or a leasing option, almost like a rental option, that they could then hand the device back after a time period. And if you could move on to the next slide for me. We selected HardSoft. We went to tender to 10 different companies. We did our due diligence, and we also spoke to other schools that were working with HardSoft. And whilst they were not necessarily the cheapest, when you factored in things like the full warranty and accident cover, along with their customer service, it has meant that we've started up a really successful partnership. Now, it was a tough time to initially, during that COVID period, to convince people about the purchasing a specified new device. And so we set up an evening where it was an open evening where we had 50 families come in with 50 devices lined up, and we ended up teaching a lesson with them. The big plus points that parents have when they purchase and or lease a device via HardSoft is that it comes with a full warranty and accident cover. And this also includes a loan device, which the school is able to give them. If a student has a problem with the device or it's a smashed screen, then they come into the school and we are able to send it off for repair or replacement. And if you go on to the next slide, we spent a lot of time with HardSoft going through the kind of finer points to ensure that it is exactly the model that works best for both ourselves as a school and as a parent. And we have both digital and kind of paper promotional materials. And it's a very, very smooth system. We currently have, if you move on to the next slide for me, please. We've got a seamless deployment of devices when they're leased through HardSoft. We use Microsoft Autopilot and Intune so that they are sort of pre-deployed in HardSoft, and then they're delivered in boxes, and we simply turn them on, and then we just have to associate printers and give them access to our school's internet. So it's a huge time saving that we have, and again, it has freed up our IT department as a result. If you can move on to the next slide for me. One of the big things that we have, and obviously whenever you're leasing something, is to make sure that it is as up to date as possible, and that those things are obviously fit for purpose and are not obsolete. And I'm talking specifically about computers here, of course. We have to make sure that our systems and software is up to date. Things like our malware, our AVG and Sophos that we use, and also to safeguard these devices as well. And having leased devices has meant that we are factoring the monthly and annual costs of using these devices, knowing that when we get to the end of the term, we are going to get brand new devices. In fact, we negotiated, and I'm sure HardSoft and other leasing companies give the options. Although we have taken a 3-year lease on devices, we are actually able to upgrade after the 2nd year if we wished. Now, if you can just move on to the next slide for me. I'm sure many of them or some of the members of your school might have gone to the BET conference. This is the annual conference up at London Excel. And I've been there every year for a number of years. And this is Dan Fitzpatrick, who's the author of the AI Educator books, talking about obviously the impact of AI and what is coming. And if you can move on to the next slide for me, please. Of course, AI is going to be challenging the way that our education system works, and we wanted to make sure that the devices that our staff and our students are going to be using are as up to date as possible. Knowing that AI and Copilot was coming, and that there was going to be a new Microsoft Surface device with inbuilt a neural processing chip, we decided to speak to HardSoft, and rather than to end our term early, we actually asked for an extension so that we could wait for this next suite of devices to come through. They were very accommodating, and our devices have performed really well. And I'm excited to say that in a couple of months, our testing team, known as our Danger and Excitement team, is going to get access to the new Microsoft Surface Pro 11s. If you can move on to the next slide for me. And it means that we have the most up-to-date equipment possible, whilst keeping a control of managing our finances, and included accident and warranty cover as well. Now, our next set of students in Form 8 who are going to be required to get the devices in Form 9 are able to take advantage of a pre-order system that we've set up with HardSoft, so they can decide on the type of device and purchase or lease method they wish to use, and those payment details are secured so the devices can be delivered to us pre-enrolled in August. We do our final cut checks so that those new students are able to then take that device for their first lesson starting in September 2025. We did, as we would do, is to take due diligence as we approach the end of our leasing contract with HardSoft to see what other options were out there and potential other companies, to have a look at. But I'm happy to say that we've been well supported so far, and this leasing strategy for both staff and student devices has been successful. And as you can see from the numbers that we spoke about, our school is kind of bucking a trend at the moment in terms of its numbers, and we're very excited about the programme that we can offer. So that's the end of my section, but I'm obviously happy to take any questions that you might have for me at the end of this session.
John, thank you so much for sharing. We do really appreciate your time and the real life insight you've been able to provide today. Thank you. I'm now going to hand you over to Louise, who will discuss the tax and financial implications of leasing for independent schools. Over to you, Louise.
Thank you, Sophie, and good morning. I've been involved with schools for a number of years, and the education sector has evolved significantly over that time, and leases have become a very important feature. I think John's just witnessed or evidenced how important it is to have technology that's obviously current and up to date to be able to educate your pupils. And obviously leasing is a way of providing that equipment, as Andrew said, without having to make that upfront payment. And COVID, I think, was a time where we saw a lot of change with educational establishments, and more leases had to be undertaken to actually be able to educate the children when they maybe couldn't actually attend schools themselves. So as a result of that, leases have advanced too. We have to actually account for leases in different ways depending upon the type of lease we're looking at. And I believe one of the comments that popped up in the box is about IFRS 16, because as from January next year, it's all changing again. So it is an area that's very, very important, not only because it obviously allows you to buy equipment that you maybe wouldn't be able to afford with an upfront payment, but obviously the impact it has on your financial statements and on your finances has to be considered as part of the overall picture. And as Andrew said, a lease is any agreement in which the owner of an asset actually allows a user to use that asset by making period payments rather than having to pay an upfront amount. Can we go on to the next slide, please? Sorry, should have moved on. So as I said, a lease is any agreement where the lessor, the owner of the asset, lets someone else, the leasee, use that asset for a period of time in exchange for a payment. And therefore, we need to be able to account for those payments correctly in your financial statements. Can we go to the next slide, please, Sophie? But before we can actually account for the transactions of making those payments, we have to establish what the lease is. Is it an operating lease or is it a finance lease? And Andrew again went through very briefly the two different types of leases. But when you're looking at the accounting aspect and the taxation and the VAT, you have to be certain which of these two leases you're actually dealing with. And it's very easy to establish what an operating lease is. It's any lease that's not a finance lease. So by default, you have to establish what a finance lease is. And a finance lease isn't really defined very clearly. A finance lease is given indicators of what may make it a finance lease. So not very helpful either. And all of this is legislation in what you have to adhere to when you're producing your financial statements, which we'll look at in a little bit more detail as we move on. But first of all, so let's establish what is a finance lease. As Andrew said, it's really where you get all the benefits of ownership. So where the risks and rewards are transferred to the leasee, the person using the asset. And I have to stress that it doesn't mean you actually own the asset. It's a real misconception. People say, well, I'm giving it back at the end of the lease. That doesn't make it not a finance lease. If basically the benefit of that asset is going to be yours, then you actually will have a finance lease. So the indicators that we have to look at, again, are not that helpful. So the lease term covers most of an asset's useful life. If the term of the lease is the majority of an asset's life, then it is likely to be a finance lease. But most, it's not particularly clear in what most means. So if you've got a 3-year lease for a laptop, if you think your laptops last 3 years, well, for most people, that would make it a finance lease. And you may be going, oh, I thought they were operating leases. But you may say that most is more than 50%, more than 75%. It's open to subjectivity, but it's one of the considerations you have to make in establishing whether you're dealing with a finance lease or an operating lease, which will need different accounting treatments. The second indicator is the present value of the lease payments, where they are substantially all of the fair value of the asset, i.e. what it would cost if you bought it outright. It's a finance lease. Again, what does substantially mean? Someone may say, well, anything over 50% is substantial. Somebody else may say, no, 90%, 80%. You can pick the figure. There is no amount quantified that means substantial. I have to say that we tend to look at 75 or 80%. Historically, it was quantified at 90%. That was removed a number of years ago now, and we're just left with this very vague definition of substantial. The next one's much clearer. The next indicator says that if the leasee has an option to purchase the asset, usually at a price lower than the fair value at the end of the lease, then that will make it a finance lease. So that one's quite clear, not too many issues in establishing that. And finally, where the asset is so specialised it can only be used by the leasee, again, it will be a finance lease. So if you have an asset that has been changed specifically to your requirements, that is much more likely to make it a finance lease than an operating lease. We have some specific leases. Now, the same rules apply. These two below will be either operating or finance leases, but property leases, often you have these for additional buildings or land. If they're more than 7 years, then they will be a finance lease. And we are beginning to see specialist leases. Again, they still need to have the same considerations in establishing whether they're operating or finance leases. We are seeing a lot of renewable energy, solar panels. Large amounts of money are being required for solar panels, renewable energy sources, and they are often now financed through leases. So we still have to consider the above 4 criteria. They are specialist leases that you do still need to be aware of as business managers in making sure you account for these correctly in your financial statements. And there's one other one, which I haven't actually put on the slide, which always throws everybody. There's something called an embedded finance lease. If you have a 5-year catering contract with a new supplier, and part of that contract says that that supplier will renew your kitchen worth £100,000, you won't have to pay for it, as long as you sign up your 5-year contract, effectively, that is an embedded finance lease for that equipment, because you're really paying for that equipment over the life of the contract. So leases are very, very complex. And I think we have to be careful when we're accounting for them to make sure we account for them correctly. And particularly now where there's VAT concerned, we need to make sure the treatment is accurate. Otherwise, HMRC and obviously fines could be imposed if they're not accounted for as they should be. So if we can move on to the next slide. Thank you. How do we actually account for these leases? So once we've established whether it's a finance lease or an operating lease, what do we have to do with it? Well, to make things even more complicated, the rules vary depending on whether you're an independent school, an academy or free school, or whether you're a maintained school. So the first two we can really deal with together. Independent schools have to follow something called UK GAAP, General Accepted Accounting Procedures. And if you're not a limited company, you follow the charity SORP if you're a trust rather than a limited company. But basically, you follow UK general accounting policies and procedures. Academies and free schools follow exactly the same. They just have some additional guidance from the ISBA on what they can and can't include as finance and operating leases. However, maintained schools follow a completely different approach. They follow what we call IFRS, which is International Financial Reporting Standards. So they have a completely different approach to accounting for leases. Now, I did see in the chat, somebody asked about IAS 16. I believe you may be referring to IFRS 16, which is the new treatment that will apply to all UK independent schools and academies from January next year. It doesn't apply at the moment. As I said, local authorities do. Yes, that's good. Apparently it is IFRS 16 you're referring to. So local authority schools at the moment have to do that already. And it is a very different approach to what you will be doing currently for your leases. I've put down the rules for IFRS 16 as it's not actually going to affect most of you at the moment. It really, in simple terms, means you account for the majority of leases as an asset in your balance sheet and as a liability in your balance sheet. So you create the asset and the liability for the whole of the value, present value of the lease, the payments of the term of the lease. But I said that's really for tomorrow rather than today, because that isn't going to be relevant for most of you currently. So if we could move on to the next slide and just look very quickly at what you have to do for a finance lease and an operating lease, so that I can talk about IFRS and the changes if anyone wants more detail later. But the simple way is the operating lease. If you have an operating lease, in other words, it isn't a finance lease, it is deemed to be an operating lease. Very, very simple. The payments are accounted for as an expense. So we debit the expense code. You debit now your VAT because you will be able to reclaim the VAT on those payments, and you credit your bank or however you've made that payment. So very, very simple to account for your operating lease. Unfortunately, finance leases are a little bit more complicated than that. We have to work out the value of the asset to go in your balance sheet and the liability that will arise over the length of that lease. And we have to do that calculation by looking at the net present value of the minimum lease payments or the lower of fair value if that is lower than those net present value minimum lease payments. So a calculation has to be undertaken before you can even do the accounting. And net present value calculations, I always use Google. If you Google it, it will give you the answer, which is always very useful rather than actually using your calculator to work out how, if you reduce the present value of each of those payments over your 3 years, 5 years or whatever. But there are lots of facilities that you can use to actually calculate that figure. So if you've got a 5-year lease, you work out what the net present value is of the payments over those 5 years. That figure is debit your fixed assets, credit your liabilities. You have to split your liabilities over due within 1 year and due outside of 1 year in your financial statements to reflect the liability that you will have to make those payments over the lease term. The asset will then be depreciated, and the depreciation has to be done on the shorter of the useful life of the asset or the lease term. Again, so if you have an asset that you think has a useful life of 3 years, but your lease is 5 years, you'd have to depreciate it over the shorter of the useful life. Now, most people would obviously change their policy to make sure it aligned with your lease term. And the usual one, again, is if it's IT equipment, most people depreciate IT over 3 years. It is increasing, I've seen recently, to 5 years. And if your lease is 3 years or 5 years, you can obviously marry those two up to be the same. As I said at the bottom, it does all change from January 2026, where we will be treating the majority of the leases as finance leases. There are 2 exceptions to that, which may answer the question that popped up, is that if your lease is less than a year, you don't have to account for it as a finance lease. And if the item is a small value item, of which small IT equipment does actually qualify, again, you can still account for it as an operating lease. So something just to be aware of the changes, but it is really important to get the accounting treatment correct. And I think the main reason for getting this correct is on the next slide, is once we've got the accounting treatment, we have to consider the impact it has on the financial statements and the impact it may have on the school going forwards. So the key considerations will be things like financial planning. So leasing can help manage your cash flow, but you obviously do need to make sure in your budgets that you've got sufficient funds to actually make those payments as they fall due. Regulatory compliance, well, unlike academies, you don't have government approval requirements, but you must still make sure that you do comply with the accounting requirements of FRS 102 and when IFRS 16 comes into play. So you do need to make sure that you are complying with those regulations. We've obviously briefly touched on tax implications and VAT. Obviously, the VAT on lease payments will be recoverable. There may be some partial exemption restrictions. It is a very, very complex area. I'm not a VAT expert. I'm like your GP, a generalist. I know a little bit about VAT, but when you actually get into the immense detail that follows leases and VAT, it is a good idea to take some advice, because there's often VAT you can reclaim that you maybe are not aware of. You have to think about your creditworthiness, because leasing companies obviously look at your school's financial health. Stable finances are important because the lease package you get may be cheaper if you're seen to be as a good school with sound finances, whereas obviously as the risk increases, there is likely to be a higher lease cost associated with that. So do bear that in mind. Procurement and best practice, obviously, I'm sure we're all here today. We know about reputable leasing providers. And again, Andrew did mention making sure you get favourable terms. That's really, really important. And budgeting and reporting, obviously, you must track your lease liabilities, and you must ensure that if you have any funding rules, that you are obviously adhering to them. And finally, make sure that you are aware when you're accounting for finance leases, it does have an impact on your accounts, and it may affect your key performance indicators. So you do need to be aware of the impact that these leases have on your financial statements. But obviously, it's a huge opening, a huge opportunity with the benefit of the VAT reclaim. It's just making sure that if you enter these agreements, you are aware of exactly what you are entering into. As with all accounting, we have to comply with something called substance over form. Whatever it says on the piece of paper is irrelevant. If somebody says something's an operating lease, it doesn't mean it is an operating lease. You still have to go through the checks that we've just mentioned to establish whether it really is an operating lease or whether it's a finance lease, because it has a huge impact on the way you actually account for those transactions. Thank you very much. That's the end of my slides. I'll hand back to Sophie.
Excellent. Thank you so much, Louise. There's a lot to grasp there. And just to remind our audience that all slides will be available after today's session. Now, I know, Helen, we're probably running out of time a little bit, but I'm going to pass back to you to hopefully cover some of the questions and the next steps.
Absolutely. So thank you to Sophie, Andrew, Louise and John. That was, very comprehensive coverage and lots to think about. We've had a couple of questions that have just come into the private chat. First one, it wouldn't be a webinar if we didn't have a question about VAT. can you reclaim VAT on existing leases that were in place before January the 1st? So who would like to take that?
I guess that one's going to come to me. Now, the answer on this one is it depends. If the IT equipment is for the students and it's being used in the supply, what is now a taxable supply, i.e. the education of the pupils, which now has VAT charged on it, then the answer is yes. If it's an operating lease, there probably is a restriction of 6 months. If it's a finance lease and it's been capitalised, you may be able to claim back all of the VAT on the payments you've made to date. Again, I'm going to caveat that there may be a partial exemption restriction because VAT is a very complex area. But if you are in that situation, it is definitely worth checking. There is likely to be some VAT that will be reclaimable. VAT and HMRC, obviously, very, very important, and HMRC don't want to give back VAT unnecessarily, but you often have to make sure that your argument stacks up, you know what you're claiming back and why, and then they usually are pretty good at agreeing to that refund.
Thank you for that, Louise. So we've got just a couple more questions. I think this is Sophie. You mentioned at the beginning leasing and device as a service. Are you able to just explain a little bit more about the differences, please?
Yeah, no, of course. And I probably mentioned that very briefly at the beginning, and as you say, without any explanation. So in relation to devices or IT in general, leasing and device as a service are in reality same, but different. They're just different terminologies. But they do tend to have different connotations. So essentially, IT leasing could denote more of a finance-only agreement between the school and a bank or a finance partner, a little bit like what Andrew mentioned earlier. There may be an element of support or insurance involved, but it's normally by using several different third parties. And in honesty, it's quite clunky and not a great experience when it comes to the school. Device as a service, or otherwise known as DAS, DAAS, it's still a leasing solution, it's still a finance solution, but there does tend to be, in modern day terms, a more proactive element involved. So the solution is not just a finance solution, but the partner does also provide an end-to-end service to the school as well. So, for example, as alluded to earlier, I think John mentioned there's more flexibility in the lease agreement itself, whether it's switching or returning devices early. Device as a service solutions also provide more comprehensive support and warranty and asset protection, and that's normally all inclusive to the solution rather than kind of different line items within the finance agreements. And some partners will do this all in-house. So I think in summary to that question, the market is a little confused between the two. My recommendation to you is to ensure your supplier that you partner with is proactive and has more of an end-to-end approach and ideally does the finance, the support and the asset protection all in-house to make the best experience for you.
Brilliant. Thank you very much for that. And kind of linked to that question from what you've just said in your answer, question for John, just to finish off. When you were looking for a solution provider, what were you looking for? And without sales pitch for HardSoft, how did you come to HardSoft as being that the answer to what you were looking for? So what were you looking for first of all?
Yeah, I mean, first of all, it was we had made our decisions on exactly the type of or range of specified devices we wanted to. So obviously they needed to be able to provide that. We also did a due diligence in terms of speaking. We got down to 3 companies in the end. We spoke to different schools that were working with those companies. Of course, cost was a big part in that, and obviously part of the ISBA Association. That's vitally important. As I say, it was the customer service and all of the flexible points that were built into the leasing plan. It future-proofed our digital strategy. and continues to do so to this day there. So it's from the pre-deployment option that was included within the lease as part of the customer service, the kind of follow-up care that we have. And in the small number of cases where families have to move away for work, reasons, and children leave our school, a kind of break clause into a lease plan for a family that has to move for those reasons doesn't leave that kind of bad taste in the mouth that they may be left with a device that they can't use in their next educational setting. So it was a whole suite of kind of reasons, and we're very pleased with the partnership that we have.
Oh, thank you, John. That was really good. The summary is start with asking questions of other people who've used various suppliers and do your due diligence and then take it from there. So thank you for that. I think those are our questions. So very nicely, it's now time, I think, to say thank you to everybody for delivering a great session. So thank you to all our speakers. Thank you to Susie in the background for all technical support. And thank you to our audience also for being with us and asking some great questions. So I hope you found that useful, and just want to wish you a great rest of the day. So thank you very much, everybody.